Welcome and thank you for your time today. My name is John Wright, and I'm here to help you grow your asset base. This webinar is designed to be an interactive experience, just as if we were sitting in the same room together. I'm here to answer your questions and engage with you, so please don't hesitate to participate. There will be several polls, and I'll also encourage you to contribute via the chat button in the upper right-hand corner of your screen. Feel free to submit questions at any point. I'll do my best to answer them. There will be a short Q&A at the end, but if I don't get to your answer, I will email you my reply later on. You should also know that only I can see your questions. The other attendees won't be able to, so feel free to speak your mind. Tell me whatever you want to say. Comment on my appearance or my voice. It doesn't matter. I'm open to any feedback. A couple of points to maximize the value of your time spent in this webinar. First, I'm going to ask you to focus on the topic. Don't bury me in a back tab behind a lot of other things and try to multitask. I do have a lot of slides to show you, and the slides can sometimes be a bit dense. I apologize in advance. I'm still learning the art of simple. So forgive, focus, and ask questions as needed. And let's begin. So by way of more introduction, my name again is John Wright. I am a former chemical engineer. Please text me in the chat if we have that in common. So as an engineer or former engineer, I'm very analytical by nature. I was blessed to attend Stanford Business School, which means I was also blessed with a hefty bill at the end. I worked off that bill through consulting with McKinsey for a short while. But most of my career has been spent in industry, working with senior management across a variety of industries, energy and chemicals, technology, transportation, retail. You can see some of the names there on the screen, but multiple Fortune 500 companies. But I left that world behind to become a registered investment advisor, registered here in the state of Tennessee. I am a fiduciary, which means I am obligated by the government to put your needs ahead of my own, and they audit me on a regular basis. The state of Tennessee audits me to make sure that I'm doing that. I'm also a chartered financial analyst, CFA, so I am very good at taking very expensive tests. And I've been featured in various media, TV, radio, podcasts on the major networks. And if you want to listen to some of those, the best way to do that is just to Google John Wright Stellar Assets, and most of those media assets will become available to you. By way of personal introduction, things that I like to do: I like to run, I like to travel, I like to invest. And when I'm not spending time looking at investments, I'm spending that time with my family. 3 kids, 2 dogs, 1 wife who is from Brazil. I thought I'd throw in a few fun pictures here, and feel free to rank them or comment as desired. My favorite picture is me actually inside a giant tortoiseshell on the Galapagos Islands. But you might like my dog Maisie's Halloween costume more, or this seemingly adorable little French poodle who is actually a terror. Her name is Mala, meaning bad dog, and she deserves every bit of that name. You're welcome to her if you'd like. I've lived many places across the United States, every major region, and I've lived internationally in a couple of countries, partly for missionary work, but also I spent 3 months in Russia after about 5 years after the Berlin Wall fell, looking at investments in Russia. So I've been to 39 different countries, so I've traveled pretty extensively. But back to relevant information for you, I also wrote a book on active equity investing. The title hopefully does not offend you. You know nothing about picking stocks. It may be true, but you should take heart in knowing that it's also true for most professionals. They fake it better than you, perhaps, but they know nothing about picking stocks either. This book started me down the path of money management. So I was still working in the real world at the time I wrote this. And I looked back at my own personal investments, and I was generating pretty amazing returns, 30% for 10 years. I sat back and I asked myself, what was I doing right? Now, something else you should know about me, I was raised in the Northeast where everyone is a skeptic. Usually they're skeptical of everyone else. But I was skeptical of everyone else and myself that beating the market was possible. I didn't think it was. And so this book was an exercise in self-evaluation and proving to myself essentially that I could beat the market and objectively looking at how I did that. What does beating the market look like? What does taking 31,000 look like and compounding at 30% for 10 years? Well, that can turn into $400,000. So I'll talk about the specific rules in a second about how I did that, but I think you will agree that um, going from 31 to 400 is a pretty good return. I will admit that this was post great financial crisis, and so the market itself did very well during this time period. The market went from 31 to would have gone to 130,000, but still, I think 400 is better than 130. So I felt I had some good success there. And mainly I had success because I stayed all in stocks. So this graph tells you why. So this looks back at the last 200 years of returns and says if you invested $1, where would you invest it? If you invested it in stocks, what would that $1 turn into? Well, it would turn into almost $1 million. This graph is a little bit old. If you invested it in bonds or gold or kept it in cash, what would that $1 look like at the end of 200 years? So obviously my book is about picking stocks. I stayed in the stock market. That's rule number one and the best way to generate wealth long term. Many of you are perhaps in bonds. You should know I do not believe in bonds for most situations, for most people. Bonds generated zero return over the last 100 years. So if you had $1 200 years ago, you'd have 281, well, 1778 today. But over the last 100 years, essentially nothing. Gold can be a good investment for hedging against inflation. And this proves that out. $1 200 years ago is worth $4 today. It's essentially unchanged. And I think gold can have a place in a portfolio. I prefer to have gold miners. So I take the inflation protection and I combine it with the wealth generation of stocks. And I think that's a great way to play gold. But certainly what you should not do is be in cash. $1 turned into 5 cents. All these numbers, of course, are inflation adjusted. So I think that's a great summary of where you should be. I don't believe in 60-40 traditional portfolios. I stay all in stocks. But how about some more detailed rules? These are the 10 rules that I follow to generate those 30% returns. And each one of these rules is a chapter in my book. And it helped me going through this to solidify my thinking. The book was written for do-it-yourself investors, but it's also helpful for prospective clients, if I'm given that honor, because this is how I think about picking stocks. This wasn't just for me as a do-it-yourselfer. This is me in my capacity as a money manager today. And these are not earth-shattering rules. Buy low, sell high. I'm sure all of you have heard that before. The problem is not identifying that rule. The problem is actually following that rule. It's very difficult in principle, hard to execute, and very few actually do it. Instead, people buy high and hope for higher. And I could give you some examples of that. But if we had more time, I do have a different webinar where I go into great detail on these 10 rules. That's something that you might want to look up or send me a note if you'd like access to that. But following these 10 rules will help you, even though they're relatively simple. And actually, I had not an investor. I had the book is available on Amazon, and I had a I've got a piece of feedback from one of my purchasers on Amazon who says that these were not earth-shattering insights, and he's right. But I hope that you can recognize the value as you walk through these rules. It's great for the home gamer, and I'd like all of you to have a copy of it if you're interested in reading it. It's a short read, about 100 pages. If you'd like a copy of this book, just type "free book" in the chat box or in the little chat button, and I will email you a complimentary digital copy. Of course, you're always welcome to go on Amazon, buy it yourself, and leave me a more positive review than that one person who said there's nothing new here. So we apply these rules on behalf of clients, and we've done so with great success in both good markets and bad. This graph looks back over the last 4 years, almost 4 years now, at my client accounts, all of which are custodied at Schwab. The blue bars represent the market, the S&P 500 specifically. The other two bars, the pink and the purple, represent stellar asset accounts, at Schwab. The equity accounts are in pink, and the equity plus options accounts, and we'll talk more about stock options, are in the purple. And the first thing that jumps out to you is the amazing returns that especially the option accounts have generated. Now, options are leveraged instruments, so it is possible to have very large returns. It makes some sense. I will point out that 2022 was just one test account, my own personal account. So I don't put a lot of weight into that. But you can see consistently that the lowest, for example, the lowest return on option accounts was plus 58% per year. And we recognize that we've lived in some pretty good times the last few years. These numbers are so large that these returns are probably unsustainable over time, but they are certainly large and have been so for the last 4 years. And at some point, I want to draw your attention to the disclaimers at the bottom. Of course, the past results do not guarantee future results. Individual results vary. Performance calculations have not been audited by a third party, etc. I also want to point out 2022, which was a down year in the market. The S&P lost 20% that year. My equity accounts lost 4%, and of course the option accounts we already talked about. I point this out because there's the risk that someone says, "Oh, you're just taking outsized risk to get this." Well, no, even in down years, we've done quite well. But as I said before, individual results vary. And speaking of individual, go back a little bit. Speaking of individual results, this is probably a good time to suggest booking a one-on-one meeting with me. So I like doing these webinars, mass communication, but at the end of the day, what matters is your individual performance. Whether you're a do-it-yourselfer and want some tips, or whether you'd like to explore how these returns are generated, how they might apply to your portfolio, there should be a pop-up on your screen to book one-on-one time. Just click that, book 30 minutes with me, and we can talk about whatever you want to talk about. Okay, so going back to the negative, the down market, we talked about 2022. This slide further reinforces that we've got a very good history in negative months. It's not that we're taking more risk, we're just being smarter about the risk we take. So this chart aggregates all negative S&P months from the beginning of 2022 through the end of this last quarter. So when the S&P was down 5% that month, we count that month, and there are 17 of those months. If we average all of those months together, the S&P was down 4.3%. Using those same months, our equity accounts were only down, they were still down, but down by less than 1%. Our option accounts, which have put options, we'll explain those in a bit, that tend to pay off in market crashes, our put options averaged almost 16% per month. Again, these numbers are over the top high and probably not to be repeated, but they certainly give an indication that strong gains are certainly possible. All the same disclaimers apply based on limited number of accounts, unaudited results, but very strong results. I mentioned that one-on-one meeting. One thing that we can do with that one-on-one meeting is address your risk. Sorry, I'll go back. So I can provide and I will provide a risk analysis of your portfolio if you book that one-on-one meeting with me today. So I can tell you how my accounts performed. We'll get into some modeling discussion later on, but I can model how your individual equities in your portfolio are predicted to do in negative months. So we can do a risk analysis for you. Okay, addressing the downside. Why is it important to address negative months in the market? And of course, fear is a reason. We'll get into that. There are a couple of other reasons. Mathematically, it's critical because a 50% decline in your account requires a 100% increase to make up that difference, right? So just mathematically, if you do a big decline, you have to struggle extra hard to get back to break even. Emotionally, we feel pain much more than we feel gain. So just being human has certainly a propensity towards fear and concern. And that shows up here in this slide, which lists the top 10 fears of Americans in 2024. And you can see number 6 on the list, not having enough money for the future. 55% of those surveyed thought were either afraid or very afraid of running out of money. So living with fear is not something that is encouraged, not something that we want to do, and not something that we need to do. This was actually, so 55% compared to 58% for the number 2. So this was very close to being the second biggest fear. As it is, it stands between Russia using nuclear weapons and becoming involved in another world war. So obviously it's of concern to people. Let's try to reduce that concern. And that's part of what I'm trying to do with you. But there is reason to be afraid, partly because retirement, the ultimate running out of money, is so uncertain. How much do you need to save for retirement? Does anyone really know how much you need to save? Some people might think they know. You might have a very impressive binder from your financial advisor spelling out exactly how you're on track for retirement. But truth be told, just like picking stocks, he doesn't know either. Because the retirement calculation is based on a bunch of assumptions, all of which are somewhat uncertain. Perhaps you know how much you will be withdrawing every month, or in this case, annually. Is it $150,000 or $50,000 a year you're going to need in retirement? What's the inflation rate going to be? Is it going to be 2%? That's the official number contained in most plans that you will see from an advisor. That's the official U.S. target. Or is it going to be higher, 5%, maybe even higher than that? How many years are you going to be in retirement? Are you going to die young, 15 years in retirement? Or are you going to be 35 years in retirement or even longer if you retire early? And most importantly, and we'll talk more about this, what's your rate of return going to be, your real rate of return? Are you going to earn 5% or are you going to earn 15%? And in my opinion, 15% is more than possible. Talk about that. So you might have a plan today that might be better than no plan at all. But given this level of uncertainty, do I need 300,000 or 3 million? As long as you don't rely too much on that plan, you might be okay. But as long as inflation, that's really the big unknown in my mind. We constantly elect politicians that have an affinity for spending money. They trade money for votes. And as long as people continue to elect politicians that have no budgetary restraint, inflation is likely to go higher over time. I don't see a likely end to that in the near future. Oops. Sorry. Okay, well, let's talk about something we have partial control over, which is how our money compounds. Because at the end of the day, the best retirement plan is to have more assets. So that's great. Save more now, but compound your money at a greater rate. That's your best retirement plan. This graph starts with $100,000 and compounds it over 30 years with no money added. It's a bit of an exercise to illustrate the importance of driving a high rate of return on your assets. And we'll start from bottom to top. So this bottom example, a 5% rate of return. This would be someone sticking their money in a very conservative investment. Maybe you're buying CDs, maybe it's an annuity. But inflation has been running 3%. So your real rate of return is only 2%. A 2% real rate of return would turn $100,000 over 30 years into $181,000. I don't know about you, but I can't live for retirement on $181,000. That's not an option that we want. So I would not be buying annuities at 5% if you plan on living off of that money. Let's go to the next option in yellow. This assumes a 10% rate of return. That's a nominal rate of return. That's consistent with how the stock market has performed over decades. The problem is we are, in all likelihood, living in a bubble currently. And that bubble at some point is going to pop. And so that 10% may or may not be realistic. Now, personally, I believe that the government has shown a propensity to step in and prop up markets, and I see no reason why they won't do that in the future if the stock market falters for an extended period of time. So I think the 10% could be realistic longer term, but it carries a cost, and that cost is government intervention, which will show itself in the form of higher inflation. So let's keep the 10% rate of return invested in the stock market, but let's subtract 5% for actual inflation if the government needs to prop up that market. That gives you a net 5% real rate of return, or $400,000, a little over $400,000 after 30 years. Better, still not enough to live off of. The blue option assumes the market still does 10%, but on its own, that we live in bubble land for 30 years, and that politicians magically get their act together and we get inflation back down to that target rate of 2%. Both of those assumptions seem optimistic, but great. If you can do that, you're at $1 million in assets after 30 years. Finally, let's consider the possibility if you can drive an aggressive rate of return and inflation remains at the current rate of 3%. That gives you a 12% real rate of return, or $3 million. Personally, I'd prefer the $3 million over the 181,000, but this is something you have at least partial control over. Obviously, you can't control inflation, but you can control how you invest your money. Is it in annuities? Is it in the stock market? Or can you find a better way? And we'll talk about this extensively, but can you find a way to drive a higher return? What do we do to drive that high return? Well, more specifically, I want to talk about what we don't do to achieve those return numbers you saw earlier. The first one is we don't dilute equity with bonds, paying next to nothing with a high correlation to stocks and providing very little protection when the market does fall. We saw that in 2022. The bonds did not provide protection. Both stocks and bonds lost significantly. So bonds are dead money. We don't want to be there. That's the first thing we don't do. Second thing we don't do is we don't buy the market. We are selective stock pickers with an impressive record. Why own average if you can identify superior? We'll talk more about how we do this, starting with the next slide. but how we end up picking superior stocks. But I do believe we are in a bubble, as I mentioned, and owning the market, which is fine long term, but that also means owning declines in the market. And so what you don't want to do is buy the peak and participate in the crash. You must be selective in which equities you purchase. Number 3, we don't time the market. So even though we believe we're in a bubble, we stay fully invested. We will always stay fully invested. Warren Buffett said it best: only an idiot tries to time the market. Don't be an idiot. I agree with him. He can't time the market. I can't time the market. I don't believe you can time the market. And trying to do so can cost you a lot of money. So there is something called the Buffett indicator. It's a ratio of total stock market value divided by GDP. The theory being the stock market and the economy should grow together. And when the stock market gets more than 2 standard deviations above GDP, the growth in GDP, then you need to watch out. Well, that's great in theory, but if you actually executed on that and used it to try to time the market, you would have gotten out of stocks at the beginning of 2021, because that's when it crossed over 2 standard deviations, putting you in the top 2.5% of all-time valuation. And what happened if you got out at the beginning of 2021? Well, we've grown 85% since then. So for every 100,000 you pulled out of the market, it cost you $85,000 in today's dollars. So don't try to time the market. John Maynard Keynes once said, the market can remain irrational longer than you can remain solvent. So we can live in bubble land for years, and years have lived there for years, and may live there for years to come. Never bet against the market. Number 4, we don't chase fads. We don't buy Bitcoin. We don't buy what I call cult stocks, as my brother often calls me for advice with his favorite cult stock. And I think he's finally learned. I keep saying, Mark, I can't give you an opinion on these stocks because I can't value them. I don't know when to get in. I don't know when to get out. And if I can't determine entry and exit, I can't invest in that. And a lot of people will make a lot of money. Great, good for them. But it doesn't fit with what I do. Finally, I try not to follow emotion. Now that's difficult. I am human, but I'm also an engineer, as I pointed out. So I tend to follow processes with my investments, try to minimize those emotions. My processes are designed to counter human nature, to lock in profits, to prevent reactive decision making. And that's what I try to do on behalf of my clients. So speaking of processes and analytical nature, I want to talk to you a little bit about the main tool that I use, which is regression modeling. That's a mouthful, regression modeling, and many of you might be unfamiliar with that. So let's start with the definition. A regression model is a statistical model that estimates the relationship between one dependent variable, the result you're looking for, and multiple independent variables, the inputs, the things that are related to that output. It is used to predict outcomes and understand the influence of various factors. Let's walk through an example. Let's say that you are in the market to buy a home and you want to predict home values in your neighborhood. In theory, that home value can be predicted, or at least estimated, based on multiple factors such as square footage, number of bathrooms, the age of the home, presence of a pool. There are other factors that are more difficult to quantify, but you can attempt to quantify them, such as the condition of the home, assign it a 1 through 10 ranking, the value of the specific street that the house is on. But the point is, you can identify inputs and then use a bunch of different data points. They call them comparables in real estate. And you can come up with a hypothetical equation to estimate that value. A constant times square foot, another constant times number of bathrooms, etc. But there will be an error term because this is an estimate, right? And it's going to be off. There are other factors that are not considered in the model. But this is a quick summary of what regression modeling looks like. The more complicated the system you're trying to approximate, the larger this error term. And things can get complicated. In a previous job at AutoZone, I managed multiple teams of data scientists who ran regression models such as these to explain and predict same-store sales, very important to a retailer. How much would sales decrease, or how much did sales decrease with a 10% drop in rainfall, or 1% higher unemployment, or a 10% drop in gas prices? It's complicated trying to extract the impact of each statistically significant variable. And the final equation for sales, for example, might have dozens of variables. But even that difficult process at AutoZone was child's play compared with price movements in the stock market, because stocks are infinitely more complex than predicting same-store sales. The error terms are larger. But even if we're only right a little bit more than a coin toss, let's say we're right 6 times out of 10, those results can be wildly profitable, as the rest of the world is getting 4.9 out of 10 or 5 out of 10 with dumb luck. But this is what we do at Stellar Assets. It starts with doing regression analytics on individual stocks. So our data point, we take thousands of stocks. For each stock, we look at hundreds of data points, and we do the math on all those data points and work into equations that predict how individual equities will do, each of those thousands of stocks, how they will do for a given set of market conditions. For example, we can model the last major decline in the stock market, and we can use that data to estimate the how each stock would do in a similar decline in the future. But as I've stated before, no one knows what direction the market will go. And there is a performance penalty to be had if you only invest in those, quote, safe stocks that will do well in a decline. So we generally don't do that. We can if the client is very risk averse, but we have developed other models instead that govern other market environments. We started with a valuation model, which is valid at all times. The risk off model talks about or estimates how each stock will decline in a overall market decline environment. But we have a momentum model. How will each stock do if the tech stocks and the growth stocks continue to dominate? What will happen with interest rates? If interest rates continue to fall, which stocks will benefit and which stocks will pay the price? So we then take all of these models and we try to find, my job is to find the sweet spot, to find the subset of stocks that are what I call robust, that have a reasonably high score regardless of what market environment we run into. So that's what we do on the regression side. I also want to talk to you about stock options. Stock options, many of you, some of you will be familiar with stock options, but let me give a quick tutorial for those who aren't. Options are leveraged bets on the direction of a specific asset. In this case, we're talking about stocks being that asset. A call option is a bet that the stock is going to go up. The call option gives you the right to buy at a specific price. And if the stock goes up, you can, at the end of that option period, you can then buy the stock low and sell it now at the current market price, which is higher, and immediately lock in a bunch of profit. It's the right, not the obligation. So if it doesn't go higher, then you just throw away the option. Similarly, the put option is the right to sell high after the stock has gone down. So if you think a stock is going down, you buy a put option. If the stock actually does go down, then at expiration, you can buy at the market price and immediately exercise your option and sell it at the higher price. But all of this has that buy low, sell high concept, right? That's how you make money in the stock market. Buy low, sell high. And this gives you an option to lock in one of those prices significantly in advance. As an investor, you don't need to worry about the specifics of how these options work. What you need to understand is that we can place leveraged bets in both directions. Leveraged bets for going up, leveraged bets for going down. Now, a lot of people get concerned when I mention the word options. They think options can be risky. And the answer to that question, can they be too risky, is a definite maybe. It depends on how you're investing in stock options. If you want to buy a single contract, that's one. Options come in lots of 100, the right to buy or sell 100 shares of stock. If you buy one contract on a single stock, yes, the answer is it's too risky, because you have to be right in 3 ways at the same time to pay out significantly. You have to be right in the direction a stock will move, the magnitude of that move, and the timing of that move. And the bottom line is you won't, in most cases, get all 3 right. And so most individual contracts expire worthless. You'll lose everything. It's kind of like going to the casino, betting on black, but maybe you got I don't know the actual odds, maybe you got a 20% chance of winning instead of a 50% chance of winning. So that doesn't work very well. Now, what happens if we pull together and diversify a bunch of these individual risky contracts? Well, that becomes more interesting. It's still too risky for most investors because there is a large month-to-month volatility there. But that diversification does produce some winners, mostly losers, but some winners. The good news is the winners in the option world often win big. The upside is often uncapped. And so in most cases, well, for call options at least. And so oftentimes you will see gains of 200, 300, even 400% on one contract. And that helps pay for a lot of contracts that expire worthless. But again, there is big month-to-month volatility. A portfolio invested only this way can easily go up or down 30% in a given month. Most people can't tolerate that sort of risk. However, and this is where things become very interesting, if you can combine this portfolio of contracts with a mostly equity portfolio, the net result is you can actually lower risk. Think of this as 2 portfolios sitting on top of each other. Think of it as 2 sine waves when combined. And the sine waves, the option contracts tend to pay out when the market is up a lot or down a lot. So when do the equities suffer? Well, the equities suffer when the market is down, but the put options, those individual contracts, the put options in the portfolio of options pay off oftentimes when it's down. So the sine waves cancel out. So you can actually lower your risk by adding a small portion of options to an equity portfolio. And we'll talk a little bit more about this. Now, I want you to consider your own situation and answer the following poll. How much risk do you find appropriate? Give you a second to think about that. We saw from the earlier that our option accounts have been extremely profitable, and I also mentioned that probably too profitable for the long run. It's got to decrease to some extent. But there are reasons why we should continue to believe they will continue to do well. The first reason is that we're not picking stocks at random when we purchase option contracts. We're using the same regression modeling that we use to rank the individual stocks from 1 to 3,000 plus. Stocks near the top of the list, those that are most robust regardless of market environment, those are great candidates for call options. Stocks at the bottom of the list, especially those which also have a poor value score, those are great candidates for the bottom of for the put option to buy put options. So we start with the right underlying stocks, and that's a lot of the secret sauce, so to speak. But there are some things about options in general that suggest we should do well in holding options. And that is specifically that people who sell options, it's called writing. So, for example, people write covered calls. This happens a lot when they have a significant gain in the stock, but they don't want to sell the stock because it'll trigger tax consequences. So how do you lock in those gains? How do you reduce your risk? Well, you might write an option, sell an option. But the bottom line is, people who are selling options are reducing their risk. They're foregoing profit potential, and we take the opposite side of that trade. So we will take on that added risk, but alongside the profit potential, which the risk averse individual is shedding for tax or other reasons. Okay, well that's enough to justify a little bit of an increase in return, but we still have an increase in risk. So step 3, we then turn around, diversify that risk by buying a portfolio of these individual options. They all come with a gain, but the diversification helps to reduce that risk. Some of these positions are going to be offsetting positions. The short answer is we get paid to take the risk, but we don't fully realize that risk because of the diversification. And finally, number 4, we are very rules based in our approach. We lock in profits on a regular basis, and that allows us to redeploy the capital. We typically are buying 1 to 3 month options. And so even if we hold the options to the end, which we don't because we're locking in profits, in many cases we don't, uh, but we're constantly turning over the capital. Think of it as a velocity of money thing, where you're using the same dollars over and over and over again. Here we're using the same investment dollars over and over again, and on average, making money on each trade. So that increases our annual return. One of those rules, so we talked about the rules such as locking in profit, but the biggest rule that we have with our option contracts is to always hold both put and call options. And that goes back to rule number 1 in my book. Just a reminder, type in the chat box, free book, if you want a copy of that. But the number 1 rule in the book is you know nothing. And the bottom line is we don't know what direction the market is going to go, and it can turn on a dime. So we always hold both put and call options. What that means is if I look at call options as a percent of my total portfolio option value, I'm always between 20 and 80%. If call options go below 20%, well, that tells me I need to be selling the other end, selling put options and buying call options, even when the market is moving against me strongly. And vice versa. If the market is booming and now my call options keep increasing in value, my put options decreasing in value, pretty soon I'm going to get to over 80% of my value in call options. That's going to force me to sell call options and buy put options when my emotions are telling me, oh no, the market is going up, up, up. So it helps overcome that emotional state. But putting these guardrails in place is very important because it's insurance, essentially. No one knows when that trend is going to change, and it forces you to take profits. And you would be surprised at how fast that 20% position can grow when the market violently turns. And you'll find yourself losing on the 80%, but the 20% will quickly make up for that. And if the market doesn't change direction and keeps going the same way, great. 80% of your options are in the right direction. You're going to be minting money on the 80%, and the cost of that 20% is going to be small in hindsight. We're talking a lot about risk and reward. And one thing I need to stress to all of you is that we are not asking people to take on more risk. We're asking them to take on more reward for that given level of risk. And regardless of what level you're at, stay there. If you're low risk, great. We can invest in equity and skew those investments based on our modeling to increase your protection in a down market. before my parents passed away a couple of years ago, I managed their money. They were 80 years old. And they were very happy because I skewed the modeling, gave them strong performance without incurring additional risk. Most people are in this medium risk bucket. And for medium risk, that's where I put those who are invested in the S&P 500. Medium risk is great. I'm not asking you to increase your risk, but there is a higher return option, namely 80% equity and 20% options. I want to talk for just a second about commodities. So you can see on this illustration that commodities have roughly the same downside risk as the S&P 500. But interestingly enough, hardly anyone holds commodities. Why is that? Well, there's no reason to take on there's no reason to own the lower performing commodity. How can I say this differently? Historically, commodities have earned a low rate of return. That's why people don't own them. And so why would you expose yourself to the same level of risk, but a lower level of return? People wouldn't. They'd upgrade to the S&P 500. Commodities were popular in the 70s. People upgraded to the S&P 500, and have never looked back. I'm suggesting you might want to upgrade it again. Now throw some options into the mix, and you won't look back at just holding the overall market. And finally, for you high rollers, an all option or mostly option account is possible, but with high volatility. So most of you do not want to be there. The point is, don't increase your risk, increase your reward for that same level of risk. So the 80-20 portfolio that I just mentioned, this looks back over the last few years, quarter by quarter, at what would have happened in an 80-20. So the pink ones are the 80-20 portfolio returns. The blue ones are the S&P 500. You can see not too many down quarters, if you will, partly because of those put options paying off when the market is down, like the first quarter of this year. We did really well when Trump announced his tariffs and the market fell apart. That was a great day for my portfolios, for my clients' portfolios. And on average, an 80-20 portfolio over the last few years has beat the S&P 500, which has been fantastic. The S&P has been doing 23% a year over this limited time frame. Amazing. And we've done 17% better than that. Again, all of these numbers are so high that we have to temper our expectations for the future. But historically speaking, things have been looking amazingly well. All the same disclaimers apply, of course. Performance calculations not audited by a third party. Individual results will vary. Past results may not predict future performance, etc. But we do recognize that 3 years is not a long track record. So we also run something called Monte Carlo simulations to approximate the range of potential outcomes. And a Monte Carlo simulation uses a computer as a random number generator. It looks at the history of that asset class and the month-to-month volatility of that asset class. And using random number generation, it plots out what a hypothetical future could look like. We ran the simulator 200 times for each of these portfolios, and these are the results. We use data going back to the beginning of 2022 for all of the asset classes, and the vertical axis is the return. The horizontal is the percent of options in the account. So this would be an all equity account at 0 options, or for the fighter pilot in you, an all options account. The top 2 lines are the average returns seen over this 200-year simulated period. And So the S&P 500, of course, isn't invested in options. So that's a flat line at plus 10% per year. The stellar equity accounts start out around 17% and then go up as you add options to the accounts. These bottom two lines represent the downside potential of each of these combinations. So for example, this would be 10% options and 90% equity. So what's the downside potential? This takes, similar to that graph with the 17 aggregated data points for the S&P 500 when it was negative, this takes all of the negative months and identifies the average negative month. And you can see what's interesting is when you add a little bit of options to a portfolio, so here we've got 10% options, you actually have less downside risk on average than, not only less than the S&P 500, but less than a portfolio with no options. So again, it goes back to the sine waves being additive or canceling each other out, I should say. So the downside risk is lessened a little bit closer to zero. And then once you get past 40% options, then you have significantly greater downside risk. So again, we don't recommend a mostly options portfolio for our clients, but it is there for special circumstances. Time for another poll. Which of these portfolios are modeled to have the most attractive risk reward trade-off for you? Oh, I forgot to mention the Sortino ratio over here. So the Sortino ratio, you're probably not familiar with that term. It's similar to the Sharpe ratio. I don't know how many of you are familiar with the Sharpe ratio. Bill Sharpe was a professor of mine. Actually, I took his class at Stanford. And he came up with this ratio of incremental reward divided by incremental risk. He won the Nobel Prize for it in economics. And it's very common in the industry. The Sortino ratio is the same as the Sharpe ratio, except it only looks at downside risk. Because if your portfolio grows 50% in a given period, that should not count against you. That's actually a positive thing. So the Sharpe ratio doesn't differentiate between upside deviation and downside deviation. The Sortino ratio only looks at downside deviation. And you can see that, and the higher the number, the better. So bonds are pathetic. A 60-40 portfolio is slightly better than the S&P, gives you slightly more incremental reward for incremental risk. The stellar portfolios are dramatically better, starting with the all equity, and then you peak in your Sortino ratios between 20 and 30%. So again, we recommend 20% for new clients, but anywhere from 20 to 30% would be a good range to be in. So we got to try to summarize what we've talked about. We've covered a lot of ground today. There are really four, I think, realistic options for most investors. You could stick with a 60-40 portfolio. Obviously, we do not recommend this. You could go with a market index. If you're going to go with the overall market, then I would say skip an investment advisor completely. It's not worth it. Why incur the extra management fees? Instead, you should start an account with Vanguard and buy a total market index fund with Vanguard, and you'll go with the market. And in the long run, you'll do great. Short run, there is risk because we are in bubble land, and so you have the risk of buying at the peak and dropping significantly. But you'll keep your fees low, and if you are in it for several decades, you'll probably do great. There's the stellar equity accounts. Again, these are managed by Schwab or housed at Schwab. We can talk more in a second about what that looks like. But the equity accounts and then equity accounts with an option overlay. Those are the four options. 3-year historical returns, 6% for a 60-40 portfolio, 10% for the market, 17% because this includes 2022. Actually, this should be more than 3 years. This is through the beginning of 2022. Includes the down year of 2022. Stellar equity at plus 17%, equity plus 20% options at 28%. The Sortino ratios you saw on the previous page, and then the average loss numbers. Interestingly, the worst average loss was found with just buying that index fund for the market. So I think this information has been helpful if you want to manage if you manage your own money, want to continue managing your own money. For those of you who might consider me as your money manager, I'd certainly appreciate the consideration. This is how we do it. The client opens up an account at Schwab or takes an existing account at Schwab. Either one is fine. Your relationship is with Schwab. So Schwab will send you your monthly statements. You log into the Schwab website and you can monitor what's happening to your account real time. Schwab will send you the tax documents. Um, and this can be either in an IRA account or a taxable account, either way. But it's a Schwab account. I don't touch your money. I don't want to touch your money. I don't have access to your money. What you do grant me permission to do is to make trades in your account, and there's a form for that, a Schwab form called a limited power of attorney, allows me to make the buy and sell decision. I do deduct management fees. Well, Schwab deducts management fees on my behalf on a monthly basis, roughly 0.1% per month, in order to pick the stocks for you. And then you and I also sit down and decide what level, if any, of options are appropriate. There are additional fees if we add options to the account. The options, there's a lot of turnover in those accounts, and so it's a lot more work than the equity accounts. So there's definitely an incremental fees that we talk about if we felt that was an appropriate path for us to go down. So I encourage you to book an appointment today. Whether you're a do-it-yourselfer or whether you want to explore the possibility, the honor of me managing your account. It's a very simple process. You've got a pop-up window with a link to the calendar. Just pick a day, pick a time of day, click, take you 20 seconds to book an appointment. And as a reminder, two reminders. First reminder is if you want a complimentary copy of my book, then type in chat, free book. But the other reminder here is a free risk analysis of your existing portfolio. So I talked about the regression modeling and how I ranked the 3,000 stocks. You can book time and tell me what you have in your portfolio today, and we can walk through the modeled downside of each of those holdings that you might have. Or we can talk about the weather. It's all up to you. Book your 30-minute slot, and we could talk about whatever you'd like to talk about. We could talk about international travel if you want. Q&A, we just have a couple of minutes here available for Q&A. So let me look through and see what I can find for questions that you've asked. Someone asks about municipal bonds. You know my position on bonds. Municipal bonds pay a little bit better. Tax treatment very favorable. I should point out that this strategy is not a tax-friendly strategy. It's one of the few downsides to what I do here. So if you do this in a retirement account, that's even better. But because I take profits early, you will end up paying taxes. That's a high class problem to have, but there will be tax implications. How can I do regression modeling at home? Well, yeah, that is a good challenge, and one that is not recommended unless you already have training in this area. It's easy to make mistakes and to get it wrong. So I would not recommend that. What do I think of AI stocks? I don't. I go based on the numbers, and sometimes that leads me to AI stocks. For other reasons, sometimes it doesn't. I'm not allergic to AI stocks. I'm not a cult follower as well. So I take the stocks as they're given to me. I currently own some Microsoft. I'm ashamed to admit I own some Palantir and some call options in Palantir specifically, because I recognize that it's highly overvalued. My valuation model is one of the worst valued stocks out there, but the other models it does great on. So So I take a little bit of risk there. Where can I find data? Last question. Where can I find data if I want to do some of this at home? I would go to AAII. It's the American Association of Individual Investors, and they sell data packages there for the retail client, and they're not unreasonably priced. You may pay a few $100s a year for a data package, but it's a lot cheaper for the retail client than the professional. So let me wrap it up there. I definitely appreciate your time and attention. I hope to meet each of you individually. Again, please book the window, ask for your complimentary book, and I look forward to talking with you again in the near future. Take care.